Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Rive to receive the top 10 stocks to buy right now. Hello, everybody. I am Travis Hoium, and I'm excited today to be joined by Matt Frankel to talk a little bit about dividend stocks. Matt, how are you doing?
Great. It's always my favorite topic to talk about dividends in the morning.
And where can we find your work on YouTube before we get there?
Yeah, so my work is on YouTube at Matt Frankel CFP.
And I can be found at Rive Project, or now with the new handles at RIIV. So pretty simple there. We were going to talk about 6 dividend stocks that we like today. I'm going to get us rolling, and this is an interesting one because they don't pay a very high dividend, but that's MGM Resorts. Dividend yield is currently 0.03%, so not going to make any high yield lists. But when I think about dividends, I think we need to think a lot about what does the future of that dividend look like, not necessarily what are they paying out today. A great example of this is Apple. It's a company that didn't pay a dividend for a really long time, and if you would have bought back in those days, you would have effectively a very high dividend yield today. And what I like about MGM is their business is recovering extremely quickly from the pandemic. I don't know if you knew this, but Las Vegas is reporting record gambling revenue in 2022. That's record all time. You know, the Las Vegas Strip was in sort of a slow decline from, I think it was a peak in 2005 through the beginning of the pandemic. Now people are going there and spending like crazy. In the most recent quarter, Las Vegas Strip actual adjusted EBITDA for MGM Resorts, which is a proxy for cash flow, $846 million. That's a lot of cash flow for a company that has a market cap of around $13 billion. Because remember, that's a quarterly number. And keep in mind that we're getting basically no contribution from Macau right now. Now, one upside for MGM Resorts is if the customers that visit Macau act the same way that customers that visit Las Vegas and just kind of go crazy when the Chinese economy opens up, that means that there could be a flood of cash flow coming from Macau on top of the already really great numbers out of Las Vegas. That's why I think this is a great cash flow business. The dividend yield isn't high today, but frankly, there's nowhere for them to spend this money. They can pay down debt. They can do that for a few years, but you'd probably still want to have a little bit of leverage on the balance sheet. They've already sold off most of their real estate. So what are you going to do with the cash? You can't expand much in gambling anywhere around the world right now. So dividends is the next step, and I think that's where we're going. What do you think about that one, Matt?
I like that one, and not just because I'm a customer. I enjoy. I think they have the best product in Las Vegas, at least. Their hotels are the best. They have the best restaurants compared to some of their rivals. So I like that, and I do agree that their dividend is going to rise going forward because, like you said, there's limited ways to reinvest the profits going forward.
What is your first pick for our top dividend stocks?
In no particular order. My first one is a company called Ally Financial. Ticker is ALLY. If that's not familiar to you, they were formerly General Motors' financing arm before the financial crisis, and the whole bankruptcy restructuring ended up getting spun out. So it shouldn't come as a major surprise that its number one business is auto lending. Ally has a huge high-yield deposit platform, which is great, and it gives it an advantage over a lot of the other big fintech operators because it finances all of its auto loans and then some with low-cost deposits. It's set up for massive profitability. Its average auto loan has an interest rate in the 7 to 8% range, and it pays an average of less than 2% on its deposits. That's a pretty healthy spread compared to lenders that have to finance their loans by taking on debt, where maybe they're getting 7 to 8% yields and paying 4 or 5% on their debt. So really profitable business model. The big fear right now is that auto lending is at an inflection point, if you will. People have been paying over MSRP for cars for a year and a half now. A lot of people are very underwater on their car loan. And there's a big fear that if a recession hits and unemployment ticks up, that a lot of people are going to run into trouble paying on their car loans. That's a legitimate fear, but one that I think is baked into the stock price at this point and then some. It's well over 50% down from its high. It pays a 4.6% dividend yield that is well covered by its earnings. It represents about a 20% payout ratio right now. The stock trades for, and get this, I'm not misspeaking, 4.4 times earnings, 4.4 PE ratio.
So what the market is telling you there is that they don't believe that those earnings are sustainable. And I think you kind of made the case that they might not be, but the question is how far will they fall? And what you're arguing is that there's enough cushion there that there's still going to be a really nice dividend.
Yeah, let's say that I'm wrong and profits get cut in half.
Yeah,
you're still covering your dividend more than twice over, and your PE is still under 9. So I mean, I think the risk reward here makes a lot of sense, and a lot would have to go wrong before this business just became unprofitable.
No, that's a good one, and one that I didn't have on my radar. I'm going to go with a company that everybody knows for my next pick, and that is Apple. Not the highest dividend yield, again, 0.66% as we're recording this, but I mean, what a business. $111 billion in free cash flow over the last year. They're just printing money, and I don't see any reason that that's going to stop. This is one of the companies in the tech space that reported pretty good results in the third quarter of 2022. And it's because, like, what are you going to do? Not buy a new smartphone, which is the device that you're probably on all day, use every day. You know, you can cut back on things like maybe Netflix because you have 5 other streaming services, but you're not going to not have a smartphone or a computer. So I think they're in a really good position as far as that goes. The services business is just another incremental add to me. And I think the value in this company is the ecosystem that they have. The smartphone is really the center of it right now because that's what the device that the most people have, but it makes Macs more attractive. It means that they now have the money to invest in making their own chips, which makes their smartphones and computers and AirPods a little bit better than the competition, integrate a little bit better. So it's like a business that's uncrackable by other tech companies. I don't see how this is a company that would be disrupted anytime in the next decade, unless there's something that completely comes out of left field like virtual reality. But I don't think that's the case right now. So I love the moat, not the highest dividend yield, but they're also, not paying out as much in dividend as they could. They're buying back a lot of stock. So that means you own a bigger and bigger percentage of the company over time. I think we'll also see that dividend yield rise over time. So maybe 5 years from now, you're getting a 4 or 5% dividend yield from your stock price today. So this is a company that I like partly because of what a big moat it has, and the fact that I just think Apple is going to be a mainstay for the foreseeable future. So why not get in on this dividend stock?
Yeah, I mean, Apple has probably the stickiest customer base I know of, and that includes companies like utilities because of their pricing power. A few weeks ago, I suggested to Travis that he might want to switch to an Android phone, and his face looked like he bit into a lemon. Like it's unfathomable for people who love Apple products to switch to anything else. And
it's impossible to switch. I mean, even if I wanted to, it would be a nightmare from like all my stuff is in the cloud. My subscriptions are through Apple. It would just be, you talk about sticky, like there's a reason that it's so hard just to get out of the ecosystem.
Yeah, I mean, and people want the latest devices. I mean, people will gladly absorb inflation for the newest Apple devices.
Exactly.
So, and that actually gives them an edge over other sticky businesses like utilities, because utilities prices are normally regulated. Apple can charge whatever it wants.
Yeah, and I think they still have a lot of room to raise prices if they want, as much as customers might not like that. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Rive to receive the top 10 stocks to buy right now. All right, what is your next stock, Matt?
My next one is kind of a tech adjacent play that you might like. It's called Digital Realty Trust. Ticker symbol is DLR. This stock has been tremendously beaten down lately. It held up really well for most of the downturn, and most of its decline, it's down like 40% from its highs. Most of that happened in the past month or so. The reason is, you probably heard of the big short seller, Jim Chanos. He came out and said his newest big short idea, he was the one who called Enron's collapse. His big short idea is data centers, and his general thesis is that tech companies are going to start building their own data centers, and Digital Realty is not going to have any tenants. Now, that may be true for companies like Apple that have, more money than most countries do. But when it comes to these high growth tech stocks, they don't want the burden of real estate on their balance sheet. Companies like Datadog and these and Twilio, high growth tech stocks, They don't want that asset heavy model going on. So to put it mildly, I don't buy the thesis. Data centers have major growth tailwinds. The volume and sophistication of data flowing around the world isn't getting smaller. Big growth catalysts. I never thought I'd be able to buy this stock at a 5% yield again, but here we are. It is at a 5% yield. One of my favorite real estate companies and great management teams. And I just think the long-term tailwinds outweigh any customers that they might lose at the high end of the tech spectrum. Like Apple, Microsoft, Facebook, sure, they could build out their own data centers. But the big growth players that need their capital for growth, they don't want to own real estate.
I definitely believe the argument that the smaller companies are going to still leverage these real estate companies that allow them to grow more quickly. My question for you is, what is the impact of higher interest rates on a company like Digital Realty Trust? Because that is a headwind, and that's not really something that's in their control.
It is. And like most real estate companies and most real estate investors, they finance a lot of their business with borrowed money. Most of their debt is fixed rate, and they have A credit ratings. They're very highly rated. So their borrowing cost is relatively low. That said, it becomes a difficult growth environment if rates stay high, because most of their existing debt is at fixed rates that they had when interest rates were low. But if they want to expand going forward and need to borrow money, especially with their stock price down, they don't want to issue new equity at these prices. It becomes more expensive to take on debt, and their new properties would be less profitable compared to old properties that they could finance at 2%. So the interest rates are a concern, but from a long-term standpoint, this is just a powerhouse business.
So kind of a set it and forget it stock, if you will.
Definitely.
All right, my third stock, the fifth on our list, is Taiwan Semiconductor. I have never looked at this as a dividend stock, but it pays a 3.0% dividend yield today. So I think that's really attractive for a business that I just don't see how they get disrupted over the next at least 5, maybe 10 years. So this is the company that makes most of the chips that go into things like iPhones, MacBooks now. They make NVIDIA's chips, basically the bleeding edge chip foundry in the world. And the advantage that they have over a incumbent like Intel, who was really the company they disrupted, is they just focus on the foundry business. They're not designing chips the way that Intel is. So they're not vertically integrated. They're more horizontally integrated. They're buying equipment from companies like ASML, who they say, hey, you do that best. You keep specializing in that piece of the business. We will happily pay hundreds of millions of dollars for a piece of equipment from you, but we want to be kind of at the front of the line when those new pieces of equipment come out. So that's how they stay on the bleeding edge. Now with the moves in China, with basically the U.S. saying we want to try to keep some of this bleeding edge chip technology out of China, I think that actually gives Taiwan Semiconductor more of an advantage. They're going to be able to probably expand a little bit around the world. They're building, I think, 1 or 2 plants in the U.S., maybe not quite the same level as what they have in Taiwan right now. But this is just the kind of business that I think the business model is so much better than what Intel had, a decade or 2 decades ago. And it takes so long for a company like Intel, if they are going to catch up, we're not even going to know that they're caught up until, middle of the decade or maybe end of the decade. So I love the business. I love where they're sitting. It takes a ton of money to build the foundries that they're building. That's their competitive moat, is that they have hundreds of billions of dollars of capital in the ground. So I'll take that 3% dividend yield all day and expect it to slowly grow over time.
I like that one. It's not a space I'm terribly familiar with, so that's one I need to put on my radar. I feel like I have a lot of tech exposure in my portfolio, but not of the dividend paying variety. So I feel like that's a good candidate to maybe change that with.
Well, and the stock has come down so much over the last year. I'm just trying to look at the stock chart here. The stock has pulled back in such a way that it has put it much more on my radar, because it's not necessarily a company that you want to pay a huge multiple for. This isn't a tech company that's low capital spend. It's actually really high capital spend. So you want to get it in that value range where you're getting a good dividend, a good price to earnings multiple. And I think we're there now, and that's what has made it much more attractive to me.
So I will go into my last one. which is probably the riskiest of the six, especially from a near-term volatility perspective. It's a company called EPR Properties, and the market really soured on this one lately, and it's not a surprise. Roughly half, or about 40% of their revenue comes from movie theater properties. They're a real estate company. Their two top tenants are AMC, which definitely got a reprieve from all the meme stock traders. They kind of got bailed out there. And Regal. Regal's parent company just filed for bankruptcy. They have about, I think, 57 of EPR's theater properties out of about 170 are leased to Regal. So understandably, it's a concern. The company also owns about the other 60% of its rent comes from experiential properties of other varieties. Topgolf is its biggest non-theater tenant.
Mm-hmm.
It leases a lot of water parks. It has the Margaritaville in Nashville is an EPR property. There's a lot of resorts, water parks, ski resorts. Vail Resorts is a major tenant of theirs. So the other 60% is solid, very solid businesses, things people that clearly want to get out and do. The theater part, the company kind of put this, gave me a lot of, relief in its earnings report when it said that Regal has paid in October and November for all 57 of its properties. They paid rent. They paused payment in September as part of, they filed bankruptcy in September. So as part of that, they didn't pay rent in September, but they resumed paying October and November on all of their EPR leases. And EPR's theater properties, is really important to know, are the cream of the crop. These are the big megaplex theaters in big shopping districts. This isn't the half abandoned movie theater showing $1.50, movies near your house.
So they could do something with these properties, even if it's not a movie theater.
Right. And that's the point. Not only could they do something, there are other operators that would gladly scoop these up if they weren't occupied by Regal. I'm sure in your area there are those movie theater chains that will serve you dinner, for example, while you're eating. They go by different names wherever you are, but there's a lot of those these are the kind of properties that would appeal to companies like that. So they wouldn't have a big tough time releasing them, most likely. The stock has been just pummeled since Regal's bankruptcy filing, down about 40% since then. Dividend yield is a well-covered 8.5% right now because the stock's been beaten down so bad. It pays monthly dividend payments and it's just well covered by the company's FFO. EPR has committed to it's a sub $3 billion company. Get this, they've committed to invest $250 million on new developments over the next 2 years without raising any capital because they're making so much money compared to the dividends they're paying out, which is really rare for a real estate company because they're required to pay out a lot of their taxable income. They're expecting to fund that just with cash flow, not dip into their balance sheet, not to borrow money, not to issue new shares, just with cash flow. And that's a really rare luxury for a REIT to be able to grow like that. So long term, I'm very bullish on this.
To put the drop in the stock in perspective, I'm looking at the price August 15th, 2022, $55.43 per share. As we're recording, this is November 4th, 2022, $38.88. So that's a 30% drop in the stock around about there, just in a couple of months on, like you said, the back of Regal's bankruptcy, and it seems like Regal's paying rent. So that seems really positive. Yeah, I like the experiential space. I think maybe not every company is going to make it, but the what I would look at with a company like EPR is, can you diversify into enough companies and enough businesses where, Topgolf does really well, maybe one water park doesn't, and it doesn't kind of sink your business. But like you said, you're getting an 8.5% dividend yield. That's your kind of flex there. So I like it. Sometimes the time to buy a stock is when the market hates it the most. And so this seems like a company like that.
Yep, I would definitely agree. And it's one that I like long term. Even if the Regal situation doesn't get completely resolved, I still like this stock from a long term standpoint. They're planning on gradually reducing their theater exposure over time. So.
All right, let's go through our 6 top dividend stocks to buy today. I started with MGM Resorts. I had Apple. Both of those are really low dividend yields, but I think over time these are going to be great dividend growth stocks. And then my final one was Taiwan Semiconductor with a yield of 3%. Matt, what were the 3 that you had?
I had Ally Financial, ticker symbol ALLY, about 4.6% dividend yield. I had Digital Realty Trust. They're a data center operator. They yield about 5.1% last I looked. And EPR Properties is kind of the most speculative, I'd say, out of the six, but not by normal speculative standards. And they pay about 8.5%.
And Matt, where can we find your work on YouTube and Twitter?
I am Matt Frankel, CFP, on both YouTube and Twitter.
And I am Travis Hoium on Twitter, Hoium, and the Rive Project, RIIV Project, on YouTube. So you can find both of our work there. Please give us your comments below. What do you think about these picks? Of course, give this video a like and subscribe to both of our channels. We appreciate it, and we will see you again here next time.